Welcome to We Build Great Apartment Communities, the only show dedicated to the process and strategies for transforming apartment buildings to thriving communities. I am your host, John Brackett, and welcome to the show. All right, folks, this is John Brackett. Welcome to another great episode of We Build Great Apartment Communities, and we improve how people live. I have here another great guest. His name is Omar Khan. He's somebody that has been in this space for a while, also a chartered financial analyst. Did I say that right?
I think so. I mean, there's three words. You nailed. You got 3 out of 3 right.
I got 3 out of 3. Okay, so I'm doing good. I'm on a roll. It's Friday and I'm on a roll. So Omar, I think this is going to be a great conversation because somebody who's been investing in multifamily real estate for quite some time. He is with Boardwalk. Okay, now I don't want to mess this up.
Wealth.
Boardwalk.
I mean, how hard wealth? You know,
Boardwalk Wealth
with a W.
All right. So, you folks have a great portfolio. You built up, a couple, in this case, it looks like about 1,200 units or so, maybe a little bit more than that. So this is going to be a great conversation. Very excited, especially since we're in an environment right now that is forcing people to evolve, look at deals differently. And so this is going to be a very unique conversation, one that I'm going to invite our audience into. Before I do that, I'm going to share with them your background, Omar, just so that they have a better feel for who you are and your experiences. So Omar, you are a CFA, which stands for Chartered Financial Analyst. You have about 10 years experience investing in real estate and in commodities. Okay, you advise on $3.7 billion worth of capital financing and mergers and acquisitions. You've also syndicated large multifamily properties across the state. And you advised high net worth individuals and entrepreneurs on various real estate matters. And here's something that I love. You're a global citizen.
Yeah, I know it's a bad word these days, right? But yeah, I make no excuses that I'm not a redneck. Yeah.
You're a global citizen. I love it, man. You've lived in Dubai, Toronto, Calgary. So you've lived all over the world. So you're going to have a very unique perspective on investing not only here in the United States, but because of your experiences abroad, I think it's going to give our audience a very unique opportunity to dive into your brain from the viewpoint of someone who's been overseas, been abroad, doing business in multiple countries, but who also still approaches opportunities with a mathematical framework. So, hey, bud, Omar, welcome to the show, man. I appreciate
you. Really appreciate you having me.
Thank you very much. Hey, so let's get into the first question, okay? Share with our audience, especially with your background. So you have a strong finance background. Where did you start before multifamily, and what drove the transition into this space?
Well, the transition part wasn't necessarily some grand plan, to be honest with you. I know different people have different stories. My story was never, I wanted to be in real estate or anything like that. It wasn't that. It was just that I had kind of done, like a lot of folks with my background, done a tour of duty, worked on the investment banking or banking side, done the corporate M&A, finance, all of that sort of work. And I was at a stage in life where, I'd moved down from Canada 5 or 6 years ago because I was getting married, and my wife is a physician over here in the U.S. So she moves up or I move down, and
right.
For the kind of background I have, I have a more cross-transferable skill because there's less licenses and all of that. So I'm very flexible in moving,
Sure.
Whereas she'd have to pretty much do everything from scratch. So it was a pretty easy decision. And plus I was moving to the US. It wasn't like I was moving to the North Pole, right? So I moved down over here. My family's been involved with real estate for the past, commercial real estate. We've never really bought houses or anything for the past 3 generations. So when I moved down here, I already had 10 or 12 plus years of experience globally and investment management, investments, M&A, all of that sort of stuff.
Sure.
So it was the right place at the right time. I always wanted to do something on my own. I was in the right country with the right amount of experience. I'd built up to that level,
Sure.
Right stage in life. That's kind of how it started. And basically the other impetus was basically, when we moved down here, when me and my wife started kind of quote unquote working business-wise, all of that, we were paying so much in taxes. And I was like, dude, screw that. I mean, at least in Canada,
right.
I know it's not a 1-for-1, but at least I get some social safety net, right? So it's not a 1-for-1. And all Americans love to tell me, well, you guys pay a lot of taxes. I was like, yeah, but I don't get hosed, right? I mean, if I was to ever become poor, I mean, there's something there, right? I mean, I'm not going to be on this, right? So it's not a 1-for-1, right? But I was like, damn, I'm paying a lot of freaking taxes, man. This freaking sucks. So And because of my personal background and my family's background, I kind of knew about all these things, structurings and all of that. So I knew, okay, there's one avenue there. I helped a friend of mine. They run a small family office out of Toronto, restructure their office portfolio in Houston. They were just passing assets to the next generation of the family, very close friend of mine. And that's kind of how it started, right? Then you do one deal, you do another one after that. And there was no grand plan. What I'm trying to say is it wasn't like I was 3 years old thinking I wanted to be like XYZ person. Like people have those dreams. I didn't really have that, right? So it was just trying to put one foot after the other, trying to do a good job, and then moving from there on in.
Beautiful. I really love that. Hey, you said something that really stood out to me, and that was the right country.
Yeah, dude, no shit. Man, I'm telling you.
Omar, talk a little bit about that, okay? Because I really love the fact that you said that. You're going to have a very unique perspective because you've traveled around the world, you've been around the world, and you've been able to see, you have a very different perspective from the person that has grown up here, right? So talk a little bit about the United States being a great country. And by the way, today is 9/11. So we are commemorating the fallen. And today I'm running 10 miles at 4:30 to commemorate our fallen. So talk a little bit about this great country that we live in.
You can actually run 10 miles? Holy shit.
Well, I'm training for something else, but today, man, I'm going to.
In one go, you can run 10 miles.
Put it down for our fallen. You can run 10 miles too. Trust me, you can.
No, I mean, I can assure you, I can walk 10 miles. I don't think I can run 10 miles.
So I'm training for another event. I'm training for another event, so I built up to that a little bit. But one of my buddies is turning 50. A bunch of us going out to the Grand Canyon doing a rim to rim, and some of us are doing the rim to rim to rim. And so there's a 24 and a 44 miler, and I'm just trying to prepare for it, man. So
miles?
I actually have fun doing it.
Man, well, good for you, dude. Yeah, look, I can tell you this. I lived in a few countries. This is literally, look, unless you're, I don't know, your family has $500 million or $1 billion, right? And they all want to give it to you to go, like, I don't know, go do your dreams and whatever.
Right.
Yeah, this is just not possible in pretty much any other country, okay? Now, you'll say, oh, there's like 2 billionaires in, I don't know, Canada, and 5 in France and 3 in India. Yeah, like 3 out of like 1.3 billion people. Okay, so your odds are definitely stacked against you.
Yes.
In the US, you have the right combination of big market size, so big enough market size,
right.
Enough people, because typically you have countries that have, say, 200 million people. Look, I'm from Pakistan. We have 200 million people. They're all dirt poor. Okay, so it doesn't work.
Sure.
Right? It's very hard to do this.
You don't have a market.
Big enough country with enough people. Yeah. So you have a market, but it's different, right? So big country, lots of people, reasonably affluent, if you think about it, even on a per average basis, even though it doesn't feel like it sometimes, right? And then on top of that, you have what I call the X factor, which pretty much a lot of other countries don't. Some are trying to get it. Some have been there. And the X factor is basically the hustle, man. The hustle,
man. I like it, man. Say that again.
Everybody's a hustler.
Man, hustle.
Everybody is a freaking hustler in the U.S., man. And I say this with the utmost respect.
Right.
Because when you're out there hustling, you know you got to go do this. And that is something you can't teach.
Sure.
Either it is or it isn't. Because you could be really rich and be a complete lazy person, or you can be nothing and be a hustler. And yeah, it's harder for you, but I mean, there's something there. So the United States has this weird...
figure it out.
Yeah, but look, you understand there is a climb, and I understand all of that part.
Right.
So there are some structural barriers for various people. I get it. But my point is, you still have to be in the right market, because you could be a genius, and if I drop you on the North Pole with nobody else around you, you're going to die. Right?
You mean you can't live off of ice and snow?
I can't. Maybe you can. I cannot. I mean, you can run 10 miles, so maybe you can figure it out.
Not in ice and snow, man. Not in ice and snow.
I don't know, man. I mean, maybe you can run 5. But you can do something. You're way better physically than I am.
But Omar, I love the fact that you emphasized the opportunity that this country affords us, right?
It's freaking...
Because sometimes I don't think we can fully appreciate that. And I always say this, I tell my kids this, I go, look, I don't think you can fully appreciate what's going on here. This is not normal. This is not how the rest of the world operates. So, appreciate what you have and find a way. I always tell them, I go, find a way to, the best way to be grateful for the freedoms that we have is to do something with it, right?
Oh, yeah.
To do something with it. So, man, I really appreciate you talking about that. Okay, so let's transition now to this business, right? You share with us your background, the mindset that you have, the hustle that you recognize in this country. And man, you're putting forward the hustle. So let's talk a little bit about that first deal that you did, right? That's where a lot of these great experiences happen. What did that look like? Tell us the story, and then we're going to get into some money-making tips, man.
Okay, look, so in my defense, what I'd like to say is, look, the first deal that I'm telling you, it wasn't just necessarily my first rodeo, because I'd structured so many deals on the corporate side. So by the time I got to my first deal, it wasn't necessarily my first rodeo, number one. Number two, purely, it's not just my intelligence or whatever, purely based on my personal and past experiences, I had done a lot of those things so many times. And by the time I was doing it for myself, or rather I was put in a position where I was doing so many of these things before that by the time I was doing it for myself, it wasn't necessarily my first deal. So the first deal was a deal in Texas. Now looking back, it seems like, it wasn't too hard. But at that time, it was a lot of like sleepless nights and stuff like that. We had to put together $5 or $6 million. I think I'm not forgetting the exact amount. And I don't know how we got that. I still don't understand how we ended up going through getting through the finish line. But that's it. The point was, I made relationships with brokers, again, because I could talk the investment management lingo.
Sure.
So at the commercial level, look, if you're dealing with some no-name broker who's, I don't know, whatever, some no-name broker, yeah, you can pull all this stuff about developing a rapport and friendliness. Because to be honest with you, look, if some big broker, and there's always 2 or 3 or 4 brokers in every major city, right? They take care of like 80, 90% of the law.
Sure.
Right? Yeah. And trust me, and the other 500 people have like 5% of the market, right? So the top 3 or 4 guys, they're probably pulling in $500 million to $1 billion off like business a year. They don't give a shit about becoming your friend. They don't care. Nobody gives a shit. If you don't talk to them, if you can't close, nobody cares, right? It's a bit.
No, it's when you're trading large transactions, there's a lot of truth behind that. Right now, when you get a couple of transactions under your belt, though,
hold on. People can like you. Nobody thinks
that's very different.
An asshole. You should be likable, but your likability has no bearing on somebody working with you on a deal. They can like you in a non-professional setting. They can be like, hey, John's a great guy, but I'm not going to give it to John because, I don't know, Bill Gates came and gave me $100 million. That has nothing to do with your level of personality.
Sure.
Right? So I could speak the investment management lingo. I talked to a couple of these brokers. We developed, quote unquote, a relationship, which is really transactional if you think about it, right? For your first deal, at least. Got through that hurdle, got through all of that stuff, closed the deal. And the couple of things that I realized there was, number one, the power of partnerships, but also the power of choosing the right partners. Because amongst that partnership, eventually I and there was one other guy. We were the only people working, essentially. But it's a good lesson because one part of being intelligent and one part of learning also means picking the right partners. So in my good luck, a lot of my partners happened to be people who did work, but also did not put obstacles in the way. Because I've heard a lot of horror stories where partners don't work and they also put obstacles in the way. So I was very lucky that way, right? But it did teach me it was a very big learning moment apart from the deal, picking the right type of partner. And again, there is no manual on it. There is no 5-step process. You kind of have to be burnt a few times just to kind of understand what you're really looking for. But going through that process more than the deal itself was very helpful in the partnership side of things.
Okay, so let's talk a little bit about picking the right partner because that's a big one.
Yeah.
Okay, it really is a big one. Now, I bought out most of my partners about 3 years ago.
Yeah.
And so now we're sold off a lot of real estate to pay off debt that we've owned in preparation for where we are today. Now, I don't think anybody could expect a pandemic, right? So now we're in a position now where we are in partner mode once again, right? For expansion purposes.
No, but you want to have a different set of partners with different set of capabilities. I'm not saying be against partnerships.
No, I understand. So we're going to get into that. But a big lesson for me in 2008, 2009, when we were going through that cycle and there was massive opportunity in that marketplace, one of the big lessons was the value of people partnering with people who have different skill sets than I do, right?
But also the mentality for me was very important because I'm the type of guys because I've worked in institutions like a lot of people, right? Where it's like, shut up, nobody cares, stop whining, or go to the corner, whine, come back, and then work another 80 hours. Right?
Okay, so let's talk about that, right? So talk a little bit about when you say partnership, the right partners. Describe to us what you mean by the right partners from your viewpoint, right?
So I think there's two components there. And I think a lot of this is shaped by my personal experiences, which is going to be very different for somebody who has a different set of experiences.
Of course.
We're all shaped by our experience.
Of course.
So in my particular case, like a lot of guys with my background, I happen to work in an industry where, rightly or wrongly, I'm not trying to justify it, there is a ritual. And that ritual is that when you enter that industry, you are expected to work 80 to 100 hours a week. And by the way, a lot of that work isn't work. It's just pretend work. You got to pretend to work. You got to play that little game where you stay in the office till late. You keep running models over and over again because you have some dumbass managing director who's going to keep, why don't you change the font color to blue or red or whatever, right? But look, that's the expectation. You are expected to survive on less sleep. You're expected to be extremely professional and competent under heavy duress and pressure. And you're expected to do this year in, year out for like 10, 12 years at the bare minimum. Right? So the plus point to that is that your average capacity to work increases a lot. It's a bit like, I'll give an example. Look, if you're playing basketball and your partner was Michael Jordan, Magic Johnson, Larry Bird, and LeBron James, and Kobe Bryant, well, you could be really shit at basketball, but in a year, you would be way better than most college people even. Right? I mean, assuming you had all the physical stuff going on for you.
Sure.
If your basketball partner was me and my bunch of buddies, I don't care how talented you are. You're going to suck. I mean, it doesn't matter how talented. So you have to be in the right environment. Take all of that experience on. So for me, what was really important was not just the fact that my partners say they're working. They have to be technically competent in what they're doing. And maybe it's just me. I like to see a resume. The same way people like me, like I show my resume to people, right? So for me, it was very important. I didn't screen for it the right way. I only screened the personality aspect of things and not the professionalism aspect of things, which I've learned both are very important.
Okay, so I'm gonna touch on something that you said, okay, because I really like this. I think this is actually something that's very undervalued, which is capacity.
Yeah.
So we talk about capacity a lot, okay, with my family because it's a big one, okay. But also with people, with our partners, with our investors. Okay. And here's the thought process behind capacity, right? Being that we're in the United States, it's an amazing environment through which we have the ability to increase our capacity in different areas, right? Yeah. So let's in this case, let's choose investing. Okay. And let's use you as an example, man. Great example, right? So going through the CFA process, that built in you some capacity, right?
Oh, shit.
So now it expanded your capacity.
Man, basically.
Exactly. It expanded your capacity in that area. Then the other side of that too now is now diving into the M&A world where there's pressure to perform, right? Whatever that looks like, okay? That's going to expand your capacity as well. So the point there being is what I'm trying to explain to our audience is in this business, because of the opportunities that we have, right, especially in this environment, this country, is we can work our way to expanding our capacity to be greater producers, okay? In fact, to be amazing producers, as long as you're not doing what Omar talked about and you're not pretending to work.
Yeah. But see, that was in a corporate setting also, right?
I get it, man. I get it. I was in corporate banking. I totally understand, man. I totally understand.
Right. So, I mean, it was that stuff. But now, for instance, now that I'm actually screening for professional competence and personal as well, because, no amount of professionalism is going to work when your personality is just off.
Right.
So I'm screening for both things now. I mean, I don't have the answers, but again, I think it's one of those processes where you keep doing deals, you keep meeting partners, and hopefully you take the good you take and the good partners take you further on. And people you might not meet at the same wavelength with, you tend to do a good job on the deal that you're with, but then you don't move on with them.
Okay, beautiful. So let's walk our audience through the cycle of a deal, right? So we just talked about acquisitions. We use one as an example. In this case, you stressed partnerships as a major component to being successful at acquiring, in this case, larger apartment buildings, right? So now we're going to move through that. Let's talk about financing. Mm-hmm. So mergers and acquisitions, I can see the parallels to acquiring multifamily real estate because there are a lot of components in there that are going to map over, right? Mm-hmm. There are just a lot of things that are going to map over, whether it be modeling, understanding the present value of money, right? A lot of little things there. So let's talk now about financing.
Yeah.
Okay. So in real estate, at least with apartment buildings, the capital structure typically looks like debt and equity.
Simple, very simple.
Okay? Very simple, very straightforward. So you don't get to do all the cool stuff. Actually, you do. You do. I have to admit, I do more banking now than I ever did when I was in banking. And that is a true statement. It's driven by structure. So talk a little bit about how you're typically financing your acquisitions and what does that look like and why?
Look, so it depends on the deal. On some very heavy value add deals, we've done bridge. We've also done agency debt. Maybe it's the current environment we're in, but I do not, for instance, as an example, understand a lot of these syndicators go out and they can underwrite to a 5-year hold, but everybody's trying to get out in 2 or 3 years. And then they do this dumbass thing where they go get fixed rate debt where your prepayment penalties are through the roof. And I just don't get it because, look, forget about your feelings. This is basic asset management, asset liability mismanagement, right? Where you're getting a 12-year duration on your bond or 10-year, but your hold period is only 3 years. So why would you have an asset liability mismatch? I mean, forget about
especially when the prepay is yield maintenance, right?
No, yeah, my point is forget about everything else. Let's assume you don't even have a prepay. Right? Why would you just not match the duration or maybe put a little bit of cushion, right? Why go that way? And a lot of guys tell me, well, I feel comfortable that way. I was like, well, what kind of dumbass answer is that? You feel comfortable?
Omar, you kill me, man.
Right. I mean, you understand? So that's number one thing that I don't understand. So I say, look, if you're a syndicator, typical. Now, if you're not, say, in my particular case, some assets, I want to hold forever. I don't want to sell. Right? But even then, I say, look, the way these loans are structured is if you have a floating rate loan, you can still buy, say, a derivative, an interest rate cap, lock in your upside. So, if you're ever that fear that rates are going to pop up.
Okay, so talk a little bit about that, because here's one of the things, right? Most people are not familiar with swap products like that or derivative products, right? So,
but they're really cheap.
I get it, but explain that to our audience, okay? Explain what a derivative product is and how you can straddle that with a floating rate or variable rate mortgage.
Okay, so a derivative, without overly complicating this, is basically it gives you...
Simplify it, man. Simplify it.
It gives you the right but not the obligation to either buy at a certain price or sell at a certain price. It's the right but not the obligation. So, for instance, you buy it, it does not oblige you to do something, but if you were to do something, it gives you the right to do it. Simply put, that's it. In the case of floating rate loans, the big debate always a lot of guys tend, and by the way, a lot of real estate guys, I don't know why it is, they tend to think they know everything about the world, which is, I don't know why they think, right? So let's assume you get a floating rate loan. A lot of people will say, well, what if interest rates rise, right? Because that's basically the big fear, because nobody has a problem when interest rates go down. Right? So let's assume your big fear is interest rates are going to spike up, right? So you buy an interest rate cap, which basically is a derivative product. What it basically says in layman's term is, and you have to set some perimeters there, right? But don't worry about that right now. It basically, let's assume you buy a floating rate loan at say 4%, and you say, look, if the rate goes anywhere above 4.5%, I get destroyed on this deal. So the most I can withstand going is 4.5%, the rate going up to, okay? So let's assume you buy an interest rate cap, which says that, look, if, and I'm overly simplifying this, that if the rate goes above 4.5%, you only pay up to 4.5%, and whoever has sold you that derivative pays the remainder.
Right.
Okay. Now you would think, why would somebody do that? Right? Why would somebody sell you this kind of thing? And the reason why somebody would sell you this kind of thing is because you're not the only person they're selling this to. They might be selling an offsetting position, which is the opposite of this, to somebody else for a greater premium.
Yeah, and that's really what's happening, right?
Yeah. And they might do this 1 billion times a day. So what they're basically doing is collecting a lot of pennies in front of a bulldozer, essentially, before the bulldozer comes and bulldozes everything away, right? So, but you have to look, if I am concerned about, like, say, some level over here, which is, say, 4.5%,
right?
Well, as long as I've capped my exposure, so I put like a hard ceiling on my exposure,
right?
Then it doesn't really matter where interest rates go, for example.
Okay, and so talk a little bit, though, about the cost of that product, right?
I'll give you an example. Ceiling. We closed a deal in December. The loan was like 20 million something, and the interest rate cap was like $17,000, which, if you think about it, is less than 1 basis point.
Right. So now compare that to yield maintenance, right?
Well, which can be in the millions of dollars for a loan.
It can be very, very expensive. Yeah, very, very expensive. So when you're straddling these caps and putting these ceilings on, what is the time frame that you're going out on these loans? So if
it's called coterminous. So you can go so first of all, you can pick whatever time you want to go 1 year, go 1 year. You want to go 3, 5.
But you're paying for it.
Yeah, you're paying everything you pay for, right?
Right.
But let's assume your loan term is 7 years, right? And you're like, screw it. I just don't want to take any chances. I don't want to be cute. I am just going to go 7 years. So you can go all the way to the duration of the loan. My point is, if your loan is 10 years, you can go 10 years. They don't care. That desk is going to price that option out and sell it to you at whatever the price is based on the forward curve and a bunch of other things, right? So they don't really care. For them, they're selling a product. For you, it's kind of like buying an insurance-like product.
Sure.
You don't have to buy it, but hey, if you need it, it's there, right?
Okay, so Omar, that was a really good explanation to our audience because it was really clear, really simple, right? The beauty of what you described is you can model that out really easily, right? You can model that out. You can model out the risk associated with the upside and creating a ceiling.
Yeah.
You can also model out the benefit in terms of cost, right? So that's one of the advantages of using that product or that type of product. And then you can also model out the duration of both of those items, right? The other side of that too is the cool thing is in the United States, which is great, you have a lot of people who spend their life, and I was talking to a really good buddy of mine who has I think maybe $1.5 billion now portfolio. And so he does this quite a bit. So he's someone that I reach out to quite a bit for this type of stuff, right? Now, one of the things that he mentioned to me, which intuitively you would think about this, my question to him was, well, help me understand, how are you projecting out interest rates? And his comment was, well, hey, John, I buy that information from people who make a living doing that.
And by the way, the other answer to that is nobody knows where these things are.
And no one knows the exact answer, right?
So you just always have to be comfortable knowing as long as I know what my upside is, like if I've kind of capped my exposure,
right?
Then who gives a shit where these things are?
So with the loan that you just closed on, what was the margin between, well, I guess there are two margins, right? So you have your base rate, you have your margin, and then you have the difference between your margin and your ceiling. What is that delta?
So I think in that particular case for the rate cap, it was like 50 basis points. Right. But I could choose what it was. I just like, you know what? Screw it. I don't think interest rates are going to go down in this next 5 years. But you know what? Investors typically have that question. So $17,000 takes care of that problem. And by the way, it's just like, I feel interest rates are not going to go up, but I don't know that for a fact.
Right.
So why not hedge my position? I can still say that interest rates might not go up, but I don't have to basically, put my project at risk.
Okay, so that was a great example of financing, right, on the debt side. Let's talk about financing on the equity side.
Yeah.
So in private equity, a little bit different, right? You're either dealing with institutional money that prices things a little bit different because more sophisticated, usually looking for a preferred return, right? Wanted to mitigate their risk in terms of position on equity, right? So talk a little bit about how you approach equity as a company, in this case, private equity, and what are some of your greatest learning lessons along the way?
Look, in our particular case, like we always put a pref position on our equity.
Okay.
Even though it hurts us technically, if you think about it, right? Because I got to do something. I got to give you something before I get something, right?
Of course.
Right? But I do feel like it's kind of disingenuous because I wouldn't invest in a product in these sorts of areas if there wasn't a preferred return component attached to it. Right. So I feel it's kind of hard to justify what I wouldn't do if I was to tell you to go do something exactly.
Of course.
Number one. Number two, typically I feel like I've heard a lot of guys say, well, we don't put a preferred return because if the thing doesn't perform, then the sponsor is not incentivized to go do the work. And I tell them, I tell my investors, if you hear anybody ever say that, you have to run the hell away from that person because the person is literally telling you to your face, this is a completely transactional relationship and I will screw you over the first chance I get.
Interesting. So wait, say that again. Say that again.
Okay. I hear a lot of sponsors say, and typically these aren't very sophisticated people, but they have a lot of assets, right? So they're not stupid, right?
Right.
They say, look, oh, we don't think a preferred return is in the best interest of the investor, because if a project doesn't perform, then it's kind of like a high water mark, essentially. Right? And if the sponsor knows they're never going to get to the high water mark, they're just not incentivized to do the work, right? And my answer to that is, look, if a sponsor is saying it to your face, then I am not incentivized to go do the work when the going gets bad. Because look, when the going is good, everybody's making money, everybody's going to be your friend. Right? I mean, come on. When everybody's making money, everybody's your friend, right? Yeah. But if a guy's going to tell you to your face that they are, and typically it's always guys, because women are not that stupid, right? If they're going to say to your face that I'm not incentivized to go do the work that I'm contractually obligated to do. I literally told you, as a fiduciary, I'm contractually obligated to do. Because, I'm not going to make any money and screw you.
Right? But okay, so I'm going to play devil's advocate.
But run the hell away, because my point is...
No, I understand what you're saying, but I'm going to play
from that sort of...
I'm going to play devil's advocate, okay? Because you have to think about the fact that you have a lot of folks out there, man, that haven't been modeling as long as you have, right? And the intricacies of finance, and also how a preferred return, how you can model that in many different ways. Yeah. So one way, the most common, is an accrual method, right? Not cash, but that preferred return accrue in the event of a default or inability to pay. So the reality is, I'll give you an example, right? If you're offering out, a 70% position, if you're selling off 70% equity in that deal, and the management team owns 30% of that opportunity, well, damn, you can accrue, you can accrue that position forever, right? I mean, so a lot of that, you really have to, I've learned over the years that one, you have to read the language. And in many cases, the way that these agreements can be written to preferred return, because it really doesn't impact cash flow, it's just a feel-good item because it gets paid out.
But see, the problem is it does put a high water level mark, right? Because the problem is if you ever liquidate this thing, let's assume you're accruing. You've been accruing for 10 years, and eventually you liquidate.
If you're accruing for 10 years, man, that property went into default like 7 years ago.
But the problem is, look, whoever signed off on the loan, what will happen is your loan has a finite term. So unless you're going hard, which is like 35 years, typically if you're going agencies, 10 or 12 years, maybe 15, but it's really 10 or 12 years, right? So at the 10 or 12 year mark, whether you like it or you don't, and by the way, the general partners don't have to like this. They either have to go refinance that loan or they got to sell the property and then get done with it. Okay. So contractually, if all of this preferred return has been accrued in all this time, well, contractually, unless the guy's a complete crook, right? What they have to then do upon liquidation is to pay you back and make you whole first, right, before they dip into the damn thing, right? Sure. Because these loans don't go on perpetually forever, right? There's a term.
But my point is, you're taking that out of equity that you already own, dude.
my point is, all I'm trying to say is, look, what would you rather invest in? Number one, before you even get into return structures, you have to, first of all, test for the quality of management in their track.
I get it.
And I can tell you this.
I'm just playing devil's advocate, man. And you know where I'm going with this. I know this.
But pretty much no sophisticated investor on the planet right now, anybody who's not completely retarded, has some level of a high water mark.
Okay, so let's this is a great segue because we're going to come back to this, okay? Yeah. We're going to come back to this. So now let's talk about, and I hear this all the time in this space, which is the conversations around, and you're going to be great to have this conversation with because you'll really understand this, risk-adjusted return, okay?
Yeah, well, what's their denominator?
Exactly.
Who decides what the freaking denominator is?
Yeah. So here's a great thing about this conversation, right? You get 10 people in front of you. You stand 10 people in front of you and ask them the same question. You ask them what that means. Every single one of them will give you a different answer. Yeah. Okay? So one of the challenges, and this is why, when you talk about private equity and preferred returns, oftentimes, I get the fact of some of the conversations we talked about earlier. But, the other side of that too, though, is it doesn't really mean much unless you understand what your opportunity cost of capital is, right? I mean, you can't price risk if you don't know what your opportunity cost of capital is.
Yeah, see, there's one problem there, though.
Okay, so let's talk about that.
As an investor, you can price it. But as a sponsor, as a sponsor, it's not just, for instance, the fact that I have to give you money. I have something much more important than that. If I have to stay in business, now if I'm one and done, that's different. And that thing is my reputation. Because if I lose my reputation and I start doing stinkers, then I am not going to be able to get money in the future, presumably.
Okay.
So something more important than just the IRR or the returns is my reputation in the market. Because to be honest with you, there's lots of sponsors who have a great reputation and they built it, say, in the first 10 years of their, say, investing career, great reputation. And for the next 20 years, they sucked, but they could ride on that reputation. Right?
What does that have to do with? So
with that preferred return thing is what I'm trying to tell.
Okay.
Just related to that preferred return thing is that if I don't put all these quote unquote quasi-governance things into place, and not just me, by the way, I just copied it from other people, right? It's not like I invented the concept. If you don't put it, then the problem becomes over the long term, you don't stay in business or you don't get to scale the right way. So there's one component of the returns and protection.
Right. I get it.
But the other thing is also visual. Like if you are eventually going to scale, you will have to deal with sophisticated parties. And when they start doing all of these analysis on you, when they start looking at you, nobody's going to stroke you a $10 million check. It's just not going to happen. So you, as a sponsor, you also have to look out for those things.
Okay. So with that said, let's talk a little bit about how you look at pricing capital, right? A risk-adjusted return. Talk a little bit about that because I agree with you. When I hear that, I always ask, well, what does that mean? It can mean a lot of different things. But from your standpoint, how do you look at that? Okay. Second question is, in the world of private equity, especially when you're looking at investors placing money, right? $100,000, $200,000 chunks. The more sophisticated the investor, the easier it is for them to quantify their opportunity cost of capital, right? Yeah. And it's very easy to do that, right? I mean, we do it all day long. But talk a little bit about that, and then we're gonna transition.
So I don't have an answer to the first question because I can tell you, look, I can give you an answer, but I could give you an answer where the denominator is my preferred rate of return. Or I can say I can give you an answer where my denominator is the S&P 500's average return over the trailing 12 years or 10 years. Because, I can give you some bullshit excuse like how that is a good comparable. Because if you didn't give me this money, you could put it in an ETF and whatever, right? I can give you some bullshit answer, which theoretically and academically sounds nice and will be airtight. But yeah, I don't have an answer to that.
So why do we hear that so much in this industry?
Because look, I can tell you why you don't hear it. Because if some sponsor, first of all, investors are to blame in this also, because investors somehow feel that if you're in a business, you're supposed to know the next freaking 10 years. And you're like, dude, if I knew what the next 10 years was, we wouldn't be having a conversation. I'd be so freaking rich. I mean, you wouldn't even get a hold of me. So, and nobody knows what the next 10 years are going to be. So it's a part of that blame is on the investors, right? Where they expect a sponsor and the sponsor gives you a more holistic answer. People tend to
wait, I don't understand. Okay, I'm sorry. When you say a part of the blame is on the investor, for what though? Why is the investor to blame?
Because if a sponsor explicitly goes out and says, somebody asks, what's your risk-adjusted return? And the sponsor says, look, I can give you a bullshit answer that your denominator should be the trailing 5 or 7 or 10 years of S&P returns on average. And you should use that as a denominator to figure out what your risk-adjusted capital would be. Or say your preferred return or the risk-free rate with a premium added on top. Academically, that sounds really good. Makes you really comfortable and cozy and warm. Right. But in reality, we don't know, because I don't know what your say, if I have 10 investors, I don't know, for instance, what is the aggregated weighted average of each of their risk-adjusted returns. So then I put it into my model and then I give you a fancy.
Okay, so let me simplify it, okay? Because, then we're going to have to bring this in, because otherwise we're just talking math and everybody's going to tune out. So let me try to have a discussion around this in a manner that is simple so people can follow. So I'll use this, okay? So let's talk about opportunity cost of capital, all right? So one of the challenges that I see that actually limits investors and their ability to make decisions is they don't understand what their cost of capital is, right? Everybody has a cost of capital. So in simplistic terms, if Omar is offering up an investment to me and he's saying, hey, John, I have a great opportunity here. We're offering out an investment with an 8% yield and an internal rate of return of, 17%. And we're looking to exit this thing in, 3 to 4 years, and it has a 2-time multiple. I'm like, okay, sounds great. Let's learn a little bit more about that, right? Now, what I'm, what I'm really considering in that whole conversation, what I'm really listening for is 8% yield. That means that I'm going to get an 8% return on my cash, right? So if I'm looking to put in $100,000 or $200,000 into his deal, my first question is, okay, what is my cost of capital, right? So he's looking to offer me 8. The closest thing that I have to 8% right now would either be number one, for many people out there, right? A return on your savings. Number two, the stock market. As you start to have more options, because this is your space, that starts to go up a little bit more. But the point there being is opportunity cost, a lot of it is a function of deal flow, right? The more options we have, our cost begins to go up. The less options we have, our cost begins to go down. The less time we want to spend on an investment and, bringing it to someone like me or Omar to invest for you, then opportunity cost goes down because we don't want to take on the work, right? We want someone to invest, manage, and produce those returns for us. So, okay, that's the quick summary and story on opportunity cost of capital. I'm going to skip the conversation around risk-adjusted return, but at least I think our audience has a pretty good idea of what we're talking about. So, Omar, now we're going to transition to the world of asset management. Mm-hmm. Okay, we talked about acquisitions, then we talked about financing, debt and equity. The cap, by the way, awesome value. Okay, that's $1 million conversation for a lot of folks. You talked about equity, structuring equity, considering how to price equity. We gave some great examples of that. Now we're going to get into the world of execution, which is asset management, right? Share with us your experiences, Omar, on asset management. And we're getting to the end of the show, but I wanted to get this in because when you build a portfolio over 1,000 units, you have to be doing a pretty good job of managing assets and paying out distributions on a consistent basis, right? So can you talk a little bit about your experiences in asset management and maybe the 1, 2, or 3 key things that you look for as an operator? Well,
number one, it's expectations management before you even get into the deal.
Okay.
Forget about asset management. Before you get into the deal, how have you set up the expectations that an investor should expect to get from this deal when they're in a deal? Number one. So if you set it too high, no amount of asset management is going to save you. Okay. So set it something that is actually achievable.
Right.
And then you pad your number so it's actually more achievable, but you're promising less. Number one. Number two, basically in a value add typical sort of deal where you're fixing and doing all that stuff. Basically, first year, all you're really trying to do is maintain your NOI while you basically upgrade as many units as possible and manage your vacancy and lease schedule as much as possible. Right? Number one. Number two. And number three, on the back end of like this thing where you're done with a bunch of the rehab, is basically when to refinance or whether you want to refinance or not, or just sell. So basically, again, lots of deep things, but those are the 3 things as an asset manager you have to be looking at. Now, there's a lot of tactical things you can do, but that's a separate conversation.
Okay, so you know what's really interesting? First of all, I appreciate you sharing those things, right? High level makes a lot of sense. If you were to name one thing that you've learned over the years when managing assets has the greatest impact on NOI, what would that be?
Cash flow management. Like you have to understand how the cash is circulated in your property, like when it comes in, when it goes out, who it goes out to, when can you delay paying somebody, do you have to pay somebody quicker, or when can you pay slightly more upfront, but then at the back end you have an advantage, right? Because work gets done quicker or some version of that. So cash management, basically.
Cash management. Okay, awesome. Omar, man, this has been a really great conversation because not too often do I have the opportunity to get into the details like this. So when I saw that you were a CFA, I was really excited because I knew that we were going to have some really unique conversations, but more importantly, that we can talk through the entire cycle of a multifamily asset. We didn't talk about disposition, the disposition component, but we did talk about, the acquisition piece, and we talked about some great examples there. We went through the financing portion, great nuggets there on the debt side. You shared some really good insight on the equity side. And then we got into some key components on asset management. And the big question was, hey, look, how do we drive? What would be the number one thing that you could share with our audience to continue to influence NOI, right? When I say influence NOI, meaning positively influence NOI, of course.
Yeah, hopefully.
And your comment there was, hey, you really need to have a great understanding, okay, of your cash flow, money coming in, and of course your control over that money going out. So man, you've been a great guest, very gracious with your time. Really appreciate the insights. And, before we get off the call and I have you share with our audience how they can get in touch with you, I always like to ask, what is the one question that you have of me that you feel may add some value to our audience?
Well, for you, basically, I'd like to hear more questions on more tackling on basically structuring and financing deals for your audience and basically on the tactical stuff around asset management, because I feel a lot of people buy into the glamour of buying, right, not into the execution, because execution is where you got to go do the work.
Okay, so let me qualify that. So say that again. More questions around
financing and asset management.
Okay, beautiful.
Because by the way, I think those two things are related, because you can be a really good asset manager, and if you poorly structured the deal, you can't do anything, man. And
I agree, man.
Have a really good structure and deal, and you're a shit asset management manager, nothing's ever going to happen.
Sure.
They're kind of linked together.
Okay, well, I really appreciate that, and I'm going to take that in for sure for future shows. And I do appreciate us getting into the conversation on the financing side, because I think it's one thing to talk about structures. It's another thing to talk about a structure where you can walk away with something that you can immediately implement, right? And I think in this market, talking about using a variable rate product, right, and then straddling that with a cap, I think that's a really valuable nugget, because it's easy to quantify that because you can price for it. It's something that you can actually buy with a fixed price, right? And you can price for that really easily. So for that, man, I want to thank you. You've been a tremendous guest, and I want to wish you continued success. And I look forward to our next conversation, bud.
Thank you so much. I really appreciate your time.
Thank you, man.
Talk soon.
Clarity of purpose creates our greatest competitive advantage. When we transform apartment buildings to thriving communities, we improve how people live and create assets with high profit margins. Don't forget to subscribe, like, and share this up with a friend. I'm John Brackett, bringing you things you can implement right away.